There's a trade setting up in silver mining stocks that offers 10 to 1 potential returns, while physical silver offers 3 to 1. Same underlying thesis, same commodity, same supply-demand imbalance. But the mining stocks give you operational leverage that physical metal cannot provide. And right now, they're trading at valuations that make absolutely no sense relative to the metal price, the free cash flow they're generating, and where silver is heading. The smart money knows this. That's why institutional ownership in quality silver miners has increased 20 to 30% over the past 6 months. While retail is stacking coins, which is fine, I stack too, the institutions are buying the companies that produce those coins at prices that won't last. Let me show you why. Start with the concept of operational leverage. A silver mining company has fixed costs and variable revenues. Fixed costs, labor, equipment, energy, administration. These don't change much whether silver is at $20 or $40. Variable revenues. Every ounce they sell is priced at the spot market. Let's use real numbers from an actual company. First, Majestic Silver, a primary silver producer, has all-in sustaining costs around $13 per ounce. That's what it costs them to pull silver out of the ground, process it, and deliver it to market. At $30 silver, they make $17 profit per ounce. If silver goes to $60, they make $47 profit per ounce. Revenue doubled, but profit nearly tripled. That's leverage. If silver goes to $90, still below the inflation-adjusted 1980 peak, First Majestic makes $77 profit per ounce. A 3 times increase in the silver price creates a 4.5 times increase in profit margins, and profit margins drive stock prices. Now let's talk about valuation. The average silver mining stock is trading at 8 to 12 times free cash flow at current silver prices. That's cheap, extremely cheap compared to the broader market. The S&P 500 trades at 22 times earnings. Tech stocks trade at 30 to 40 times earnings. Even gold miners trade at 15 to 18 times earnings. Why are silver miners so much cheaper? Because the market doesn't believe silver is going higher. The market is pricing in $28 to $30 silver forever. But we just went through the supply-demand math in the previous video, the 200 million ounce deficit, the industrial demand growth, the constrained supply. If you believe that math, if you believe silver reprices to $50, $60, $80, $100, then these mining companies are absurdly undervalued. At $60 silver, a company like Hecla Mining or Kerr Mining would generate free cash flow 3 to 4 times their current market cap in 1 year. That's not sustainable. Either the stock price rises or the company returns all that cash to shareholders through buybacks and dividends. Either way, shareholders win. Let me show you the specific companies the smart money is accumulating. From the 13F filings we covered earlier, here's what the major institutional investors are buying. Wheaton Precious Metals. It's a streaming company. They provide upfront capital to miners in exchange for the right to buy a percentage of production at reduced prices. High margins, low operational risk, pure exposure to metal prices without having to actually operate mines. Druckenmiller increased his position by 40% last quarter. That's not a small trade for him. First Majestic Silver, primary silver producer with operations in Mexico, all-in costs around $13. At current prices, they're printing free cash flow. Institutional ownership up 28% over 6 months. Pan American Silver, another primary producer with mines across North and South America, costs around $14 per ounce, institutional ownership up 18%. These aren't penny stock mining companies in unstable jurisdictions. These are established producers with proven reserves, experienced management teams, and strong balance sheets. And they're trading like silver is going nowhere. Now let's address the obvious risk. Mining stocks are volatile, more volatile than the metal. When silver drops 5%, mining stocks can drop 15%. That's the nature of leverage. It works both ways. So why take that risk instead of just buying physical? Because the return potential is asymmetric. If silver goes from 30 to 60, a 2 times move, your physical silver doubles. But a well-run mining stock with operational leverage could go from a $10 stock to a $60 or $80 stock. 6 to 8 times return. Same silver thesis, much higher return potential. The key is position sizing. I'm not saying put your entire precious metals allocation into mining stocks. That's too much risk. But if you're 70% physical metal and 30% mining stocks, you get the stability of the physical position with the upside leverage of the equities. And you can start small. You don't need to buy 10,000 shares. Buy 100, buy 50, scale in over time. Here's what to look for when evaluating silver mining stocks. First, all-in sustaining costs below $15 per ounce. This is critical. If a company has costs at $20 and silver drops to $25, their margins get crushed. But if costs are at $13, they're still profitable even in a downturn. Second, reserve life. How many years of proven reserves do they have at current production rates? You want at least 10 years. Anything less and you're betting on exploration success, which adds risk. Third, jurisdiction. Stable countries with rule of law, Canada, US, Australia, premium jurisdictions. Mexico is acceptable if the company has long operating history there. Avoid countries with nationalization risk or political instability. Fourth, management track record. Look at insider ownership. If the CEO and board own significant stock, their interests align with shareholders. If management owns nothing, they're just collecting salaries. Fifth, balance sheet. You want companies with low debt and strong cash positions. When silver rallies, you don't want a company that has to use all the extra cash flow to service debt. These filters eliminate 90% of mining stocks and leave you with the quality names. Let me show you the math on a specific example. Take Hecla Mining, ticker HL. They produce about 13 million ounces of silver annually, plus some gold and zinc as byproducts. At $30 silver, they generate approximately $200 million in free cash flow annually. Their current market cap is around $2 billion. That's a 10 times free cash flow multiple at current silver prices. Now run the scenario where silver goes to $60 over the next 2 years. Their free cash flow goes to roughly $600 million annually, tripling because of operational leverage. If the stock re-rates to just a 15 times free cash flow multiple, still below gold miners, the market cap goes to $9 billion. That's a 4.5 times return from current levels. And that assumes silver only doubles. If silver goes to 90 or 100, the return potential is even higher. Is this guaranteed? No. Mining stocks can underperform even when the metal rises if execution fails or costs blow out. But the math is compelling, and it explains why institutions are accumulating. Here's the allocation strategy I use and recommend. Core position, 60 to 70% in physical silver. Coins, bars, allocated storage. This is your insurance. This is what you never sell. This is purchasing power preservation. Leverage position, 20 to 30% in quality silver mining stocks. This is for upside. This is what you sell into strength when silver spikes. This is how you capture asymmetric returns. Cash reserve, 10%. For opportunistic buying during corrections and for living expenses, so you don't have to sell metal or stocks at bad times. This structure gives you stability from the physical, upside from the miners, and flexibility from the cash. And within the mining allocation, diversify across 4 to 6 companies. Don't put everything into one stock, spread the risk. Start small if you're new to mining stocks. Buy 1 or 2 shares per paycheck. Build the position over 6 to 12 months, dollar cost average, just like you do with physical. Let me end with this perspective. Physical silver preserves purchasing power. Mining stocks create wealth. Both have a role. The institutions buying mining stocks aren't doing it because they don't believe in physical silver. They're doing it because they understand leverage. They know that when silver reprices from 30 to 70 or 80 or 100, the mining companies producing at $13 costs will see profit explosions that drive stock prices far higher than the metal itself. And they're buying now while the market still prices these companies as if silver is going nowhere. You have the same opportunity they do. The stocks are publicly traded. The information is available. The valuations are transparent. The question is whether you'll take advantage of it while the leverage is still available at reasonable prices, or whether you'll discover mining stocks after silver's already at 70 and the stocks have already done a 5 times move. The smart money is moving now. The data is public. The math is clear. Position accordingly.